Hi, John Terry with Vision Advisors, and I want to say thanks for joining me. For those of you that joined our live broadcast a little bit ago, we had some technical issues with our carrier partner out on the West Coast. After I wrapped up my impromptu presentation and walking you through an overview of Growth Commander, they got everything resolved, and we are very excited to have James Marco on the line with us. And as promised, I told you we'd get James on a recording to share with you what you missed. So James, what I'd love for you to do in the few minutes we've got on this video call is let's give everybody a high level overview of what they need to know as this product's going to be released for sale tomorrow, February 15th. And it's going to be available at that point in time. And then you and I can come back and we can do a deeper dive in a later webinar where we can go into a little more detail for those that want to learn more. And in the interim, for any of you that have questions after seeing this, feel free to reach out to us here at Vision Advisors, 1-800-505-8489. You know the number. You can also find us at visionadvisorsinc.com. Our phone number is there. But James, thank you for joining me. Appreciate the friendship. Sorry you were having technical issues earlier. I'm glad those are resolved. And let's talk about this exciting new product, Growth Commander. And by the way, if you're saying something really cool and I jump on top of you, just be prepared because I'm excited about this product.
Thank you for the love, John, on this Valentine's Day very much. Sorry for the technical difficulties. Here's the good news. We're going to shortcut some of this stuff and get into the meat and potatoes of the entree here on this hot new product coming to you from Valentine's Day of 2022. February 15th is launch day, and it's Growth Commander FIA.com. It's the dedicated microsite with the brochure. The illustrations go live tomorrow. By the time you watch this, we're probably live on growthcommanderfia.com. So we are excited about this, and it is a limited distribution. So you got to come through Vision Advisors. This is really built with Americo. It's a limited distribution product. It's not available through all IMOs. Legacy is helping in the product design, some licensing and commissions, but this is your product. It's built for the independent channel, but it's a limited distribution. It's only through some select IMOs. We've had long-standing partnerships, and one is Vision Advisors. So you have the unique ability to get this limited distribution product from a group that can give you some real personal service, kind of the best of both worlds. I think John covered the carrier Americo. To your client, it's Americo's A-rated paper. That's the financials. They've been around for over 100 years. They've been through pandemics. They've been through world wars. They've been around for a while, and this ain't their first rodeo. So exactly what you're looking for in an American-based insurance carrier.
Hey, James, real quickly, let me mention too, for those that are listening, because this is a proprietary product, there's separate contracting involved to sell this product. Because you have Americo with Legacy of the Americo Shelf product, you don't have access to this product without separate contracting. So that's another reason why you need to contact us at Vision to get appointed, because if you're already currently Americo appointed, you still don't have access to this without that additional add-on. So excuse me, James, but I want to make sure they knew that.
Good point. And they do allow dual contracting. So most of the agents with Vision are already aboard Legacy. There's a one-pager you need to get access, like you said. But let's say you're joining us and you used to run final expense. Americo's known for that, and you have it through a group you've had through forever. They allow dual contracting for just this product. So if you run into those stranger situations, get a hold of them. There's a licensing form where you can access just this product, and it is limited distribution. They allow dual contracting. So let's not let any of those hurdles or bumps in the road. A one-page licensing form might be your ticket to get this product. So here's some big features. These are the big ones, and we have some select strategies, a bunch of them that have participation rate, or the rates or caps, they're par rate linked, but the rates are locked in for the full 6-year or 10-year chassis. There's a 6-year Growth Commander 6, Growth Commander 10, but there's some strategies that the participation rates are locked in for that surrender schedule. Any of those who know what I'm speaking of, this will overcome any renewal rate anxiety, renewal rate and questions, because we have the renewal rates on these strategies. I'll show you some of those here in just a moment. There's a value lock strategy. a new strategy that's kind of a set it and forget it. If the index hits the cap of 7, it automatically is going to lock in a cap automatically. I'll share that with you. This product has a 1% minimum guarantee. We're calling a walk lock. Regardless of whatever happens in the product or markets in the world at the end of 6 or 10 years, clients guaranteed a real value, a 1% independent compounding value, and they get the greater of. So put yourself in the shoes of the client. Getting a guarantee with further upside, clients looking at CDs at the bank or other products where you have return of premium, well, this guarantees them a value. It's called Growth Commander, guaranteed growth with further upside. They get the greater of a 1% minimum or the higher upside. They walk with the greater of the two. Product also has strategies that have a fee if they want to buy up their upside, or no fee options. These are optional fees if they want to pay them. Here's the big one, and I'm going to say it a few different ways. If the client chooses to pay a fee or not, that does not impede on this minimum guarantee. Even if they paid a fee to buy up their upside, and if everything goes perfectly wrong, our minimum guarantee is invisible to any fees. The combination of these four, it really makes the product stand out. There is nothing out there quite like this. John, I think, has covered that. I like just to say more than a century. 1908, or is it 1909 when they started out of Kansas City and in an office in Dallas, Texas? That's your American story. They're older than your client. They were in business when the last pandemic hit, that 1918 Spanish flu. They've been around, not their first pandemic, they've been through world wars. Here we are today. Hang your hat on the longevity of the carrier. It makes me feel confident just saying it out loud. I've said that out loud dozens of times. So into the product here, carried by Americo, your clients are in charge. So we have a 6 or 10-year chassis. The 10-year chassis has slightly higher rates for the client by extending to 10 years. Your fee for service, I think, is slightly higher on the 10-year. Or there's a 6-year version for you agents or clients who want a shorter product for whatever reason. Comp is still pretty good. It's a little bit less. The rates are still really strong. So we have both. And what you're going to hear me say on this is we got it all. We have S&P. We have proprietary indices. We got shorter product if you want it. We got a 10-year product if you want it. They're all through age 85. They take up to $2 million without home office approval or any commission haircuts. I'll get to comp later. Let me build some value first. But it's $2 million, 0 to 74. A lot of carriers cut comp or change things over $1 million, or you have to jump through a bunch of hoops. Send us up to $2 million. If you got a bigger than a $2 million case, ask John for the jumbo case form or someone at Vision. We might be able to give you some good news if it's over that. Older age group, they want to limit it to 75 to age 85. They have shorter life expectancies. I think you know how products work, so they got to limit their exposure because the product's too good, to put it bluntly. Index gains, best till date at death. There's a lot of friendly features for the older age client. Got to just cap it at $1 million though. Minimum premium is $10,000. It is a single premium product. We can bring in multiple transfers, but once we hit the issue button, that's it. It's one and done. 10,000 minimum up to $2 million. No market value adjustment. It has no income rider. It doesn't have a death benefit rider. It doesn't have market value adjustment. It's simple and clean. The simplicity, if you don't know what market value adjustment is, well, don't worry about it. You're on the right product. But this is a clean, true walk away. The carrier is fine if your client sticks beyond the 6 or 10-year duration. But once they're beyond that, there's no penalties. There's no snakes in the grass. There's no market value adjustment ever. It's a clean walk away contract. Consider the 6-year. Maybe do it in and get out in 6 years. If there's something better out there in 6 years, move your client, make another commission that suits their needs better. Sounds like a win-win. Consider the 6-year. I think it's got some pop in my opinion. The walk lock is the industry-leading minimum guarantee. It's 1 on 100. So clients are guaranteed to receive no less than 1%, and you want to look at it at the end of the 6 or 10 years. At the end of 10 years, we'll look at your minimum guarantee. It's 1% compounding, and the surrender schedule, the surrender penalties are off. So here's the value you're guaranteed, or your account value, which could have the moving parts. big returns back in, a small fee of 1.5 if they want to pay it or not. Regardless, they're guaranteed this with further upside. So that minimum guarantee is not impacted by option fees. Pay the fee, buy up your upside. Worst case scenario, you paid a fee and you didn't get anything and it impeded your account. They're guaranteed the minimum guarantee in the worst case scenario. What the math and science says is if they want to pay this index fee, they'll net out perfectly. They'll net out better ahead. Here's the beauty though, to fee or not to fee, it's an option. It's available today. It's available next year. It's available the year after that. We don't have to pay any fees out of the gate a year or two down the road. If and when the market corrects or crashes, guess what? We can get to a fee when we think it makes a lot of sense. Wouldn't you want this on your product? Not pay a fee today, but if and when the crash happens, you can pay an optional fee to double your upside. I think that just makes tons of sense, and it's an optional fee. So let's take a look, a deeper look at that. Here's a 10-year market segment where it actually, the S&P ended lower than where it started. If it happened once in the past, it could happen again. Where this shows Growth Commander minimum guarantees 1 on 100. Yes, $1 million would be 104,620. It's a true make money guarantee with further upside. Clients might appreciate that more than us agents do. So don't undersell that. This has a variety of penalty-free access, RMDs, and waivers. I'm going to move past this. I don't think this is, it's very client generous. Just know that. That's not the most compelling reason to buy the product. It's good to have in there. But what is a compelling reason is the upside potential matched with the minimum guarantees. So let's go through some strategies. There's 8 index options. You need 500 at minimum in each one to have it. Index gains vest at death. So we do have 1 year, 2 year. We even have a 5-year strategy. Objection is, what if my client dies prior to the end of the duration? It's all handled here. If they died in the middle of a 1-year strategy or a middle of a 5-year, we would measure the date of death as like an anniversary and apply gains. This panned out with my own parents. To get real personal, this means something to me. I told my mom she'd get a check for $148,000 on Tuesday, and like $154,000 came in on Friday because the index gains till death. Let me tell you, when your client, especially your mom, gets surprised with a check that comes in many days early and $6,000 long, this means something to me, and it overcomes the objection of using a multi-year strategy with an older age client. I like these little things: minimum guarantees, index gains vest at death, no market value adjustment. There's just like a lot of little things that add up to a really big good thing when you kind of add them all up. On the flip side, you might know of products out there that got a lot of little things you don't like. I'm hoping this has got just a bunch of little things. When you add them all up, it really is a significant smile on my face because I've experienced some of these things. So here we go. Here's the big one. John, look alive if you want to jump in there, because I'm going to say a lot on this page. These first 3 strategies are here for a reason. If you, the agent or client, likes S&P linked type strategies, we got them. If you like more upside with a par rate on an exclusive indice or a hybrid indice, we have those too. What it allows us on this 1 year, 2 year Morgan Stanley, 1 year, 2 year global balance is we have a new term at Legacy: participation rate lock. Participation rate lock. They're only on these 1, 2, 3, 4 strategies. They each have a buy-up you see here. So these 8 strategies, if you look at the buy-up, have participation lock guaranteed if you're looking for that. The S&P ones don't. So they have a cap or par rate that will renew. These are more volatile. S&P, they'll renew. So 5 years from now, I don't know what the renewal cap's going to be on these first 3. If interest rates are lower or if they're higher in 5 years, they're going to fluctuate accordingly. We kind of want that in case they are higher. These strategies have the par rate locked for the entire 6 or 10 years, and you know what your renewal rates are going to be. And we like that as well. We like the best of both worlds. You'll see that there's a 5-year strategy. I'll probably go over kind of quickly here, and a declared rate. but we're hoping to have the mix of what you're looking for. The Mark V, so John, he mentioned, we'll do a deeper dive on the strategies. Tomorrow they'll all be live. I'll have more information. So on a very high level, if you want raw S&P, we got it with a cap or a par rate. If you want S&P like a Mark V, some of you agents like, hey, I want S&P-ish, but if there's a little gold for safety or US Treasury in there, the mix and a ball control for a higher par rate, we have that as well. So the Mark V will be popular for some of you. If you're looking for par rate guarantees and big par rates and big upside, the Morgan Stanley and the next strategy I'm going to show, those are the two. This is a 10% target volatility, so a little bit higher on the target volatility. Story here is Morgan Stanley. If you look them up, they were on like 4 Wall Street or 5 Wall Street is their address when they started. It's a US story. It's Morgan Stanley is going to be US sector EFTs only. Gold is a defensive hedge. Risk control is going to have US treasuries in there. So it's US centric with gold, US sector EFT only. This is our American story with an American company. Some people like American stories with American companies. Some others might prefer a global story. They say, well, I just want something that's going to be a bit more global for whatever reason. So develop a Société Générale. If I can say it in my French accent, they're the 3rd largest bank in Europe out of France. If you read the bullet point here with me, offers diversification across global market and asset classes. Some people believe a bit more resilient to events that might impact some or just one country. This is a 5% target vol. Back to the high level. If you're looking for global indices that got pop and have upside, if you're looking for American, US centric, if you want bread and butter, good old fashioned S&P, we have the whole smorgasbord available to you and your client, and you can allocate to all of them with or without a fee option. And we've had a product in the past, the one I sold to my parents. I've seen what a fee does. They made a 19% return after 2 years, and I'm a fan. Some people, the best part of one of our products is this fee to get a higher return. But now we have it as an optional fee, allowing your client and you, the agent, to have control. And I've said it before, you can go in without a fee, make some money for a year or two, call it house money, some contract money, and then pay a fee down the road. And exactly, not pay a fee if and when the market crashes, then pay a fee. We already know the renewal rate. So to fee or not to fee is the question. We have the option to move back and forth. What it does is it buys, you're buying up, you're upgrading your par rate or cap. With that fee, they use the 1.5 fee to buy more options. So you can get a higher par rate, more of those options for greater upside potential. The math and science says it should net you out ahead. You can allocate between a buy-up and no fee at the end of the duration, whatever the strategy is, a 1 year or a 2 year, whatever it is. Then you can reallocate and change. Your client every year at your anniversary will ask you, I can change strategies and switch between buying or not buying. And you're going to say every year, absolutely. That's the beauty of the product. And then reallocate accordingly. The 1.5% fee is deducted from the par. It's from the strategy at the end of each contract year. So again, we don't have to pay any fees if we don't want to. You can put 10% in a fee, just a small percentage, and not fee the other 90%. All these options / control for you and the client are all available. And I just think it makes a ton of sense. My own personal bias, maybe not pay a fee right now and get to it down the road. That just makes so much logical sense to me. And if the market never crashes, we got good upside on the no fee strategies. It might make sense to pay a fee after this massive correction, if and when that happens. I love it. That coupled with the par rate locks. Any of you agents have a carrier who the renewal rate got soft after a few years or 5 years or whatever? You don't have to worry about that. So let me read the slide here. John, you're welcome to chime in here because I want to know if you had any experience and if this is going to resonate with the group. Participation rates are guaranteed never to drop for the length of the surrender charge period. It's on those 4 strategies with or without buy-up. It can help overcome renewal rate anxiety, offers a higher probability of achieving illustrated returns. I like that. We know the rates 8 years from now as we're illustrating this thing. I know the renewal rates on those strategies 6 or 8 years from now. and it applies regardless of transferring in or out of the option. So this is a good one someone asked about. These are set in stone, whether you allocated it to it from the get-go or you transferred out of it, it doesn't disappear on you. 8 years from now, we still know what they're going to be. Even if you didn't allocate to it, you don't have to get a piece in there to hold it. It's the way you want it to be is one way to answer it.
Hey, James, just real quickly, another way to
please.
think about that is you essentially have no moving parts in this particular annuity. One of the major concerns that we've heard producers hear their clients complain about is after the first or second year, there's a change in the participation rates and they want to start complaining. Yep. This takes that complaint away and it allows your clients to have certainty in the fact that they're going to know exactly what their participation rates are going to be for 6 years or 10 years, and those are locked in. So they can essentially do the math knowing if they're at let's assume it's a 60% or 80, whatever that number happens to be, they're going to know that's what they're going to get every year for the next 6 years or the next 10. Thanks,
Wonderfully
James.
said. Thank you. Now, please do that again if you're so compelled. Offers the probability that illustrated return to be more accurate since the par rates are renewing right where we illustrated them, assuming all 10 years. I think it's more compliant. It makes sense. You can move in and out. You kind of get your head wrapped around the minimum guarantee is invisible to fees. It's exactly what I would want on my own product if I was to own it. So I think I like that. Industry first. So I'm going to go through this one quickly. Here's my apology up front. This is a really cool set it and forget it kind of strategy. There's a competitor of mine where if the client gets so far into it, they can push a button and lock it in. This is similar, but it's automatic. Let me go through this quickly with your permission per se. We can do it. I want to do a deeper dive call with everyone here on the strategies after launch here. But for some who want to put a portion of set it and forget it, it locks in a cap. So let's go through this a bit quick and we'll circle back on it. There's a 7% cap where as the index hits that cap any day during the year, it's an automatic lock-in. So you don't have to do anything. Unlike my competitor, this is a set it and forget it. It's automatic. It's pretty cool. So let's go through this here. 7% on the high end. There's a negative 10% floor at the end of the 5 years. 0 is still your hero, but we gotta keep a scoreboard along the way during the quarters. 0 is the crediting. It is a multi-year strategy. It's a 5-year strategy on the 10-year product. It is a 6-year strategy on the 6-year version. So it is available, and some people like a portion allocated to the set it and forget it no-brainer strategy. So let's take a look at this. Index goes up. It actually hit our 7% cap at some point during the year, and it swelled back down. What does the client get? Unlike my competitor, is the kind of the message here, where you have to push a button, this does it automatically. If that index hits the cap and goes down, your client is automatically going to get the 7% cap locked in. We're going to add up every year's numbers and times it by a par rate at the end. If they died in the middle, we know we got that objection addressed. Index gains till death. In this example, the index went up. Didn't quite hit the cap though. It went up 5%. Write down that number. In this example, the index never hit that cap and ended up lower, went down 2%. We got to write down the negatives too. This example, the index started here, it ended lower than where it started, but since it hit its cap at some point near the beginning of the year and then subsequently dropped, as long as it hit the cap during the year, they get it. Here's good news too. It does reset. So in this example, you grabbed your cap and it fell here. It resets every single year. So nice design, by the way. And in this last year, if the index, let me get one more click here, blows past the cap, 7 is the max here. So once we have our 7, 5, negative 2, 7, and 7, we get a sum multiplied by our par rate. And at the end of 5 years, bam, we get to credit the big chunk. So there's no buy-up on this one. This one's a non-buy-up. These are just the standard rates and caps without the buy-up. So without any fees, 7% cap, and then it's multiplied. Pretty slick crediting method. And again, it's the automatic, you don't have to do anything client, it will lock it in during the middle of the year. And we're looking at 5 and 6. Interestingly, our 6-year product, because it's a 6-year strategy, I think it's priced slightly higher. So you might even look at this in the 6-year product if you want to diversify within it. We try to have a mix of a little bit of everything. If you like longer strategies, the set it and forget it. So if you want 1 year only, if you want S&P, we have it. So this big page, and John, you're welcome to chime in. Here are the 3 S&P. These are going to renew annually. The renewal rates have been good, but again, 5 years from now, these could renew higher or lower depending on the climate. We don't know, and that's good to kind of leave these open. They're volatile. It's S&P. Volatility can be pricey, but they all have the buy-up. So if you like S&P and you don't like caps, look at a 24% par rate. It squeaks out a pretty good number, but if the client wants to pay a 1.5% a known fee up front, it nearly doubles the par rate. You see 46%, and now they're making 5.44. And an index annuity on a 1-year S&P linked, I think I like that. The fee or not to fee is the question. You can net out ahead. The Mark 5, there's the par rate because of the vol control, and it nearly doubles that too if they want to pay a fee. And here's the example I like, John. So this the SG Global or Morgan Stanley, par rate 60 and 83. Let's say the client likes the fee idea and the upside, but they think the market, the crystal ball says it's going to crash. It's going to crash any month here, right? So they can go into the 1 year, 2 year no fee and anticipate some pretty good returns on a 1 year basis. A year or 2 down the road, if the correction happened, what's the renewal rate going to be next year or in 2 years or even in 8 years? Well, it's 166. If the market crashed, we want it to crash catastrophically and it resets, maybe down the road, pay the 1.5% fee, and you can get all the upside in horsepower, kind of like a variable annuity. It's everything you might like about the upside of the horsepower of a variable annuity. Sorry to say those words out loud, but it's everything you love about a fixed index annuity with real guarantees, no mandatory fees. It really is, I think, it's got the upside ceiling, he's got the guaranteed floor, really the mix of kind of the best of both worlds with an optional fee structure. The 1 year Morgan Stanley, 2 year Morgan Stanley, you see the 2 year par rate, it does well. Pay a fee of 1.5% per year. It is per year. I skipped ahead. At the end of each year, it doubles, it buys it up, and you can net out over 8%. Pretty darn good. And there's the 5 year. I'm switching to the 6 year product. As a barometer, you see my S&P 3.4 and 24% par. Here's the 6 year, 3.25 and 23. It's not priced much less rate-wise. So the client has incentive to go to the 10 year. It's going to have higher rates. It's a little more higher down here. But consider a 6 year. If you're willing to make a smaller fee for service, they get a clean, beautiful, nice 6 year growth product with some pop. And at the end of 6 years, you can sit down with them and assess the situation. See if it makes sense to stick with it or move on to greener pastures. The carrier is okay for you to stay. Look at these numbers with and without fee on a 6 year chassis. John, please chime in. This product looks pretty hot. Before I get to commissions, I think the 6 year is a standout. What do you think?
Well, the 6 year product allows you to serve the client that has a shorter term duration, or if you also happen to have a Series 65 and you're working with clients and you want to have those shorter surrender penalties because you're stacking assets to create different buckets that you can pull from, this gives you some flexibility. But the thing I like about both the 6 year and the 10 year, you've got the US, S&P 500. Everybody knows the S&P 500. It's a name that people know. But then you also have the ability to have a couple of proprietary strategies, one US focused and another that's globally focused. So again, depending on where you think money's going to be moving or where your clients think money's going to be moving, it gives them some unique options. They've got the ability with some of these unique strategies to do the guarantee of the participation for 6 or 10 years. And then this unique value lock feature, you don't have to press a button to make something happen. If it blows through and it goes through the cap, they're going to get that number automatically. And then after you do the factoring and you put in that participation rate, that's an opportunity to really see some significant growth over time.
Well articulated. So 5.74. Yeah, actually, that strategy, because the 5-year version's on the 10-year divide by twice. Don't scoff at the 6-year. We actually, on that 6-year strategy, because it's 6 years, it's priced a little more handsomely here. An allocation, 10 or 20% here, a mix of things here, to fee or not to fee. There's a great conversation and a way to really help your client throughout the next 6 years and a walk away if we want to do the 6-year walk away. And I think on that note, here are some street comp. I'm pleasantly surprised because this is an exclusive product that it's paying very well. The 10-year product, your fee for service, again, this is coming from the carrier, not out of the client's pocket. This ain't real estate. 0 to 75. Street comp is 7. 76 to 85. What are you making on your 83, 84, 85-year-olds? That particular comp on a product like this, very, very strong. I think you're making a very fair fee for service for your hard work. And here's the 6-year. If for a little bit less money, and there's a lot of reasons, compelling reasons by you or the client, a 5% comp on a shorter 6-year product, that's compelling. How about an older age client? You want to do a shorter product, 4% comp, 10 or the 6, the comp is very strong. The product is strong. Your fee for service is good at all ages. The older ages are pretty good standout. So I'd say all good news there as far as the total package. So tomorrow, if you go to the website this moment, it says coming soon. growthcommanderfia.com. No, we didn't find out till 2 weeks ago the name of the new football team. That was by Better to Be Lucky Than Good. We named it Growth Commander and filed it before the that new Commander football team came out. Hey, better to be lucky than good. I guess I'll take it. But that's all going live. So your product training's there, product kits, illustrations. What you'll want to reach out to Vision Advisors for is a 1-page licensing form where we'll connect you to them so you can sell the product, and then you'll have access to everything else. So with that, I think I want to click through. I want to say hello. Thank you for your interest. I want compliance to say hello. And any questions from you, John? I'm going to stop share here.
No, James, I just want to say thank you for taking time to share this unique, exciting product with us. We are very honored to be one of a handful of IMOs in the country that has this as part of this unique limited distribution opportunity. So I want to invite the producers that are watching this webinar to have an opportunity, if you haven't already completed the form to get access to this proprietary product, reach out to us today at Vision Advisors. 1-800-505-8489 is the number here. And we just hit 0. You'll be connected to any of the business consultants immediately. And we would love to get you set up. This product is available Tuesday, February 15th for sale in the marketplace. You do have to do product training. So make sure you get that done. We've got the sales guide that you'll need to review to do that, and instructions on how to do that is going to be on the same website that James shared just a minute ago. I put it in the chat that you should be able to see as well, growthcommanderfia.com. Everything you need to do business with that carrier, aside from getting appointed with Vision, is right there. So once you're appointed with Vision, we can rock and roll, and we can start running illustrations, as can you tomorrow. So if you've got a case upcoming, let's have a conversation about whether or not Growth Commander is suitable, appropriate, and serves the best interest of your client when they're looking for that accumulation strategy. James, thank you again, my friend. Always good to see you. For those of you that have joined us, I want to say thanks for joining us and have a great day.